Crude oil markets experienced notable volatility last week, driven by mixed economic signals and geopolitical tensions that pushed prices in different directions. WTI crude ended the week below the crucial $78 per barrel threshold, weighed down by concerns over China's economic slowdown, despite earlier fears of supply disruptions from the Middle East. Traders were caught in a market balancing bearish demand conditions with potential geopolitical risks. China's economic struggles significantly impacted global oil markets throughout the week. New data revealed major weaknesses, with home prices falling at their fastest pace in 9 years, industrial output slowing, and unemployment rising. These factors led Chinese refineries to sharply cut crude processing rates, signaling weak fuel demand and heightening concerns about global oil consumption. In response, both OPEC and the International Energy Agency revised their demand forecasts downward. OPEC lowered its global oil demand growth estimate for 2024 from 2.25 million barrels per day to 2.11 million, citing weaker than expected Chinese consumption. Similarly, the IEA reduced its 2025 demand growth forecast, noting the waning impact of China's post-pandemic recovery. Despite a bearish demand outlook, geopolitical tensions in the Middle East offered intermittent support to prices. The ongoing conflict between Israel and Hamas, along with threats of retaliation from Iran, kept fears of supply disruptions alive early in the week. The U.S. responded by increasing its military presence in the region, initially sustaining bullish sentiment in the oil market. However, the risk premium tied to these geopolitical tensions lessened as the week went on, with Iran holding back from immediate retaliatory actions. This shift allowed market attention to return to the more pressing issue of weak global demand, particularly from China. In the United States, economic indicators provided some support for oil prices, though the impact was limited. Speculation about a potential interest rate cut by the Federal Reserve, spurred by lower-than-expected inflation data, hinted at possible future support for oil demand in the world's largest economy. However, U.S. crude inventories, as reported by the EIA, showed an unexpected increase, signaling that domestic demand might not be as strong as anticipated, which contributed to the market's bearish tone. Looking ahead, the outlook for oil prices remains bearish as global demand concerns, particularly from China, continue to dominate market sentiment. Although geopolitical risks in the Middle East remain a potential wild card, the lack of immediate supply disruptions and ongoing weak demand signals suggest that crude oil prices may struggle to gain upward momentum. Crude oil is likely to remain under pressure, potentially testing lower support levels if demand worries persist. The oil market is under pressure as traders focus on demand worries. It looks that geopolitical premium has declined due to Gaza ceasefire negotiations, which was bearish for oil markets. In case WTI oil settles below the support at $76, it will move toward the next support level at $72. However, crude oil may find support in the $72-$74 range and might attempt a recovery from recent multi-week lows. Please like and comment to support the channel. See you in the next one.